Let me start with you, Jim. What do we read into this market? Are happy days here again? I mean, we did have a really nice gain this week.
David, I think you could spend a couple hours looking through all the fundamental data and not find anything that really supported a big increase in risk appetite this week. So I think you really have to attribute it to the fact that we had a couple weeks of softness preceding this, and then sentiment is terrible, and then technically the market is making higher lows, so technically it looks okay here. But if you think about what's going to drive the market over the next 6 to 12 to 18 months, the growth outlook is deteriorating. Europe's likely in recession. China's clearly in recession. The U.S. 50-50, we think, over the next 12 months. The Fed and the ECB are raising rates resolutely. And the inflation picture, while improving, is probably overly discounted in the markets. A one-year break even on the tips is at 2%. So we think that the environment is probably not as robust as this week's market action might indicate.
Well, I'm sorry, Sarah. When I hear 2% in a one-year break even, that sounds like maybe inflation's coming back down again.
I think that number is coming back down. Inflation's moderating. We'll likely see a little bit more moderation when CPI comes out next week, but that slope is probably too aggressive. I think inflation will remain sticky. We have higher wages and higher shelter prices. Those likely stick around, and that's going to keep core inflation numbers probably much higher, and I wouldn't be surprised to see that break even actually increase over time. The other thing we're watching for is the Fed. Before we decide if this rally is sustainable, we'd want to see more signs of a Fed pivot, and we're not seeing that. So we agree with Jim. This is probably not a sustainable recovery.
Well, what about the Fed pivot? Is it dead, effectively? I mean, it certainly sounds like Jay Powell recently has not been saying much that would be consistent with a pivot.
I don't think we're going to see a pivot in early 2023. What Jay Powell has been saying is that he's going to do what's necessary to fight inflation, even if that comes somewhat at the expense of the economy. And given that inflation likely has these sticky components to it, I think he continues to raise rates, likely 75 basis points at the September meeting, and then more moderate rate increases from there. If anything, you'll see a pause in 2023, but you won't see rate cuts until we hit a recession and we see that demand destruction.
Yeah, and David, we've seen in the last month a reduction in the cuts that the market has priced in. They were pricing in 50 basis points of cuts in 23. It's now come down to just 25 basis points. And what I'm most interested in keeping an eye on is the labor markets. I think the Fed can't stop raising rates because growth is hurt. They can't stop because the market is struggling. They need to see the unemployment rate increase to give them cover to be able to start slowing down the pace of increases.
So next week we get CPI numbers, right? What are those going to tell us, Jim? What do you think about headline and core?
Well, I think the key is going to be the pace of improvement. I think there's very little doubt we're going to see improvement in the overall rate. But as Sarah mentioned earlier, the progress on housing and the progress on labor are really the two most key. And they're key because the supply issues on both of those are really considerable. And the only thing the Fed can do is hurt demand. They can't increase supply in either of those areas.
So, Sarah, this doesn't sound that rosy about the U.S. economy and where we are. But if you compare it with Europe, or you compare it with China, for that matter, we're in a lot better shape, aren't we? What about that divergence among the economies?
I think the U.S. is still the safe haven region of the world to be in. The economy is much more resilient. That's giving the Fed leeway to continue to raise interest rates. We're not seeing that resiliency in the rest of the world. And that's also why the dollar is so strong, and we expect it to remain strong, because the U.S. stronger growth, higher interest rates, the currency will be that safe haven trade. And that's an issue for earnings going forward. Jim mentioned employment. We're also worried about earnings. Consensus has been pretty positive this year on earnings growth. And our concern is that earnings will eventually get hit because of the strong dollar, margin compression because of inflationary costs. This is going to be an issue for companies that don't have pricing power.
So that was one of the big stories of the week, right, Jim? The dollar was setting record after record after record. We had Bill Dudley, the former New York Fed president, on Bloomberg this week saying he thinks the Fed actually wants that strong dollar because it actually slows down the economy.
Yep.
But what does it mean for investors?
Well, it's an issue for investors from the standpoint that it is positive that it will slow growth, but it does hurt earnings. And it's a negative for the international investments where you're seeing the depreciation of those currencies. Foreign markets have actually done not as badly, but when you translate them back into dollars, it's really been a much more difficult market.
Does this say anything about small caps versus big caps?
Well, it does. The small caps would tend to have a little bit less exposure there, but conversely, small caps are more exposed to higher interest costs and more difficulty in handling higher input costs. They tend to not have as much pricing power. So they win on one front, they lose on the other.
So, Sarah, what are we all missing? I mean, you're at Nuveen, you see all this stuff. I know you've got some secret sauce there. What are the markets missing? What are we missing?
I think one of the key issues for the markets is valuations. This is what we're surprised to see, is that valuations for stocks actually are not that cheap. And even with earnings at risk, they could look even more expensive. If you look at history, during periods of high inflation where you tend to eventually hit a recession, market returns can be quite strong after that. But if you look at valuations in those historical periods, they were much lower when that happened. So that's why we're more concerned about the markets and think that it's likely that valuations need to crack before we would get interested.
Oh, that's interesting. So we got further to go down, you think, at least. So do you agree with that, Jim, or do you have something else you think the markets are missing?
So our experience is that while valuations clearly are important, they're much more important to long-term returns than they are to 12-month returns. There's a very little statistical relationship on a short-term basis. So we don't look at valuations as a timing tool, but they're very important for intermediate to long-term returns.
So what about the cause and effect of the U.S. dollar strength, Sarah? Is that because our economy is that much stronger? Actually, I talked to Larry Summers, who said it's because we've got such a strong energy position, particularly compared to, for example, Europe, which is struggling so badly.
It's a combination of many factors. I think it's correct. It's because of our strong energy position. It's because of our relatively stronger economy, our pace of aggressive rate hikes. All of the things make the dollar stronger. And another headwind for the economy and the markets going forward, particularly earnings.
So as you look forward, Jim, you think this dollar is going to continue at this strength or even get stronger?
It probably will continue at this level. I'm not sure how much stronger it will get from here because we are going to get towards the end of the Fed cycle sooner than we will other central banks. But an important part of our investment philosophy is you do not want to take a lot of risk in predicting where currencies are going to go because it's an incredibly difficult thing to do. Hedge your liabilities and use your risk budget on other investment ideas.
Certainly sounds sound to me. You agree, Sarah?
I do. I think that's a great philosophy.